Good evening, everyone. We are kickstarting Rise with India Prime Time with the Money Show. As always, I'm Mubina Kapasi, and this is your one-stop shop for everything to do with your money and your finances. Today, here's what we have lined up for you on the show. How to curate the ideal portfolio that will help you meet all your long-term goals, be it retirement, be it your child's education, or just be it for any other purpose. What exactly is it that you should also keep in mind when you want to decide to redeem a mutual fund? Because it's not necessary that every MF could be that golden goose in your portfolio. Second, gold prices are at record highs. In many parts of India, in fact, they're even commanding 38,000 rupees per kg. And I'm sure given the fact that Indians love gold, a lot of you guys may have already capitalized on that opportunity. But for all you guys out there who may not have, and I'm sure there's a very small percentage out there, how can you make the most of gold is what we are going to discuss. And finally, for all the investors out there in the DSP Equity Fund, we are going to catch up with the fund manager, Atul Bhole, to talk about what his investment strategy is and what should the unit holders watch out for. This is the Money Show, and it's always dedicated to getting you rich. How can you do so? Well, simply by investing in the equity markets. And we are not always talking about direct investments. Of course, the most common method of wealth creation is mutual funds. And this, believe me, for somebody who does not have the correct knowledge or the correct exposure or the correct experience in investing in equity markets, is a great savings and investment option. However, when it comes to kickstarting your investment journey, how can you pick and choose which mutual fund would help you gain your long-term goals? And also, does it mean that every mutual fund can turn out to be a golden goose for you? Well, not necessarily. Some of them can be big wealth eroders as well. And we have seen that happen in the last few months with some mutual funds having big exposure in companies like ILNFS and DHFL. So let's discuss that and more with Feroz Aziz. He's the Deputy CEO of Anand Rathi Private Wealth Management. Hi Feroz, it's always a pleasure having you with us on the Money Show. While we often say that mutual funds is a great way in the long term to create your wealth, we often get this question, how should I pick a mutual fund? There are several mutual fund houses, and within that mutual fund house, there are innumerable, funds. So how I, as a long-term investor whose goal would be perhaps wealth creation for whatever purpose, should pick a particular mutual fund? How should an individual know what's right for them and what's not?
See, I think very, very pertinent question, Mubina, because if I draw up a context for this, the first thing is you have about 450 odd equity mutual funds. All of them are called equity mutual funds. Second, you have 42 asset management companies, and you have 10 schemes per asset management company. And the worst part, or something which you need to know of, is that the best and the worst scheme every year has a 28% difference in performance. So if you go wrong in the scheme selection, then the performance could be significantly dampened. So in the same asset management companies, the dispersion is wide enough. So the question is very important. And how does one choose a good scheme? Of course, there are several parameters to be looked for. The first one is the time spent by the fund manager managing that scheme. Second is the consistency in returns. So you should ask your advisor for rolling returns, which is a very good measure of consistency, not just the last 3-year return. You should ask for rolling returns, which tells you the average 3-year investor at different points in time would have made what. So the rolling returns is a very, very important criteria. The risk it takes. So let me get a little technical, but it's still simple enough. So standard deviation of the fund needs to be low. Standard deviations of less than 12, 13 is phenomenal. So that's one thing you have to check. You have to look at the fund house. You should stick your equity money in the top 10 asset managements only. When I see investors investing in the 30th largest asset management company, then I say you don't have to spread your money so thin. Stick to the top 7, 8, 10 fund management companies, because the research is deeper. The number of analysts are far more. So these are the few of them, but of course
they have more money to pump into proper research.
Last bit is you should take electronic medium, especially the Money Show will be giving you advice, and that's going to be unbiased any which way. So I think that's a very good platform to probably get the piece of advice without any biases or commission driven biases especially.
Okay, well, yes, fair enough, and I will really acknowledge that endorsement. Yes, the Money Show is always here, of course, to help you create long-term wealth. And yeah, top 7-8 fund houses. Do not go for the 30th or the 31st biggest fund house. Just try and keep it among the top 7-8 fund houses. Feroz, another question is how many are too much? For example, we have some portfolios that we get that comprise of 12 and 13 fund houses, and then there are some that just comprise 1 or 2. And as we know, a mutual fund is already a product that is diversified in itself. So how many funds are too many?
See, I think we should look for answers in investments towards the data. So data and statistics clearly suggest that if all of them are investing back in the Indian capital markets, it's important to not diversify into more than 7-8 funds. So statistically, 7-8 funds is the maximum diversification you should choose to get into. Because if you do anything more than that, you would be buying the entire market itself. So buying the market and beating it is next to impossible. So stick to 7-8. Anything more than that is redundant. If you don't like, if you want to have another one, replace it rather than add it with an existing one.
Okay, all right. So that's essentially the basic do's and don'ts of what to do when you're selecting a mutual fund. But now, of course, Feroz, and the more tougher question, I suppose, especially because all our biases creep in here, when you buy a fund, you tend to sort of look at the positives, maybe ignore the negatives, and you want to believe that this one will be able to bounce back or it will be able to create wealth. This is a stock market bias, it's a share bias, and it can creep into mutual fund investors as well. But when should investors realize that now is the time to redeem a mutual fund?
See, there are two things which you need to categorize reasons into. If it's an external factor, if the markets have been bad, don't panic and exit a fund. So never get carried away by just absolute returns. It is but natural that if SIP is being done over the last 2 years, would be showing negative return. If that's certainly not the parameter to exit, point one. Point two, you should look at something called relative return. If you are an investor, it's your duty to learn a little more and see what's the benchmark of the fund. If the fund has consistently over the last 2 years delivered below the benchmark, it's definitely something which you need to be concerned about, and it is definitely one candidate on the annual to exit from your portfolio. Always review a portfolio when the fund manager changes. Go beyond the name of the fund, know your fund managers, see whether there's a change in the fund management. So that becomes a structural change. So that's one strong reason why. Third, when the scheme's strategy changes or the philosophy changes, quite a few times schemes go through philosophical changes or they get merged in for different reasons. So that's one more reason you should exit. And fourthly, when you look at risks which are far more than accepted, and if you see standard deviations of 18 and 20, which get reported, in fact on public domain you will find that. So these are the 4 reasons why I would quit a fund. But make sure that you are agile enough and vigilant enough in times like these, and if you do that, then I think your portfolio should be able to get a couple of % more if you just not stay the course without any reviews.
Okay, so I understand standard deviation essentially reflects how much risk a fund has. When you mentioned portfolio churning, I, as an MF investor, I can access a fact sheet which comes monthly, and like you mentioned, those reports which come quarterly. But how do I know when my portfolio is, or my fund manager is tending to churn the constituents a lot? Is there similarly a technical term like standard deviation that I can spot in the fact sheet?
Yes, there's something called the churn ratio. Churn ratios are very easy to interpret. If the churn ratio is 60% per annum, it means that the constituents have changed to the extent of 60%. Okay. If you have 100 different shares, hypothetically, if the churn ratio is 60, it means that 60 of them have changed, at least in the form of weightages. Okay. So churn ratio is very easily available and easy to interpret. The extent of churn per annum is what it depicts.
Okay, so what would be an ideal churn ratio then?
So I think any churn ratio more than 25-30% means that the active management is significantly more than desired. Okay. Because if a fund manager bought a stock, then he should be buying it from a perspective of 3-4 years, which marries with the investor's objective. If the investor is buying it for 4 years and the fund manager is buying it for 6 months, then there is some dichotomy between the person who's managing it for the person who's investing. So that's a good check. And
so ideally a standard deviation should be under maybe 12% and your churn ratio, it's not desirable that it is more than 25 to 30% that you would say are, apart from of course returns, etc., etc., some of the key parameters when you're selecting
So
a
on the
mutual
standard
fund?
deviation, probably you can be a little generous. Up to 14 is also fine.
Okay.
But it's important to get a benchmark. Since it's a technical concept, I think
Yeah.
it'll be fair to tell the viewers what is Nifty standard deviation so that they have a benchmark to compare.
it. Yeah.
Nifty standard deviation over the last 3 years has been 12.89. So anytime you see a small cap fund throwing up a 18 standard deviation, it implies that you're taking significantly more risk than Nifty. So I'm just trying to give them a benchmark so that there is some comparison when they see the fact sheets.
Yeah. Okay, all right. So there you have it. I think it's a complete Bible of what you should be looking at when you are selecting a particular mutual fund. Like Feroz said, there are more than 40 AMCs out there. Try and skim it to the top 7, 8. And then, of course, look at all these parameters when selecting your mutual fund. Well, as always on The Money Show, we are going to kickstart Ask the Money Show segment. This is your opportunity, folks, to get your portfolio vetted regardless of whatever your objective is. Feroz here will, of course, help you out with that. The number will appear on the top of your screens, 24990388, or you can email us, though, of course, calls are preferred for now. Okay, let's bring on board our very first question. It is from our regular viewer, Anita B. She says, I have a mutual fund portfolio of roughly 30,000 rupees. I believe this is a monthly SIP, and she has put in her SIP in various schemes. There you have it. There's a large cap fund. Again, another large cap fund, then there's an emerging equity fund, and then I think there are 3, 4 more funds. But basically, this is what her portfolio is. She split her 30,000 equally, almost equally actually. A small cap fund, 2 of them has around 2,500, and then there's a provident fund and PPF, 10,000 rupees. Her questions are that she has certain goals in her mind. She wants to know what should she do if she wants to essentially save for her daughter's wedding, and B, also for long-term wealth creation. Essentially, retirement is what she is looking at. She's also said that these are for specific investment portfolios. Children's education in 12 years, 50 lakhs. Marriage, 60 lakhs. Unfortunately, we're still spending more on marriage than education. Retirement in 25 years is 5 crore rupees. So these are all, of course, long-term goals. I mean, her first goal is going to kickstart only 12 years later. I'm assuming her daughter is relatively much more younger. So first question is, does her portfolio require any changes? 2 small cap funds, and I think there were 2 large cap funds and 1 more emerging equity fund. How would you read into her portfolio, Feroz?
So as we were previously telling our viewers to not get into smaller AMCs, here we have an example. Parag Parekh Equity Fund is not in the top 10 asset management companies at all. So I would not bet my rupee there. I would rather stick to the larger asset management companies. You already have a Kotak Emerging Fund, but let me recommend you another multi-cap fund, which is on the Kotak side itself. Kotak Standard Multi-Cap would be a good addition to the portfolio. You can swap it with Parag Parekh Equity. That's one change. You have 2 small cap funds, again like we were referring just a little while back. The standard deviations or the risks of these 2 small cap funds, which is HDFC small cap and SBI small cap, is significantly more, especially after the huge rejig in the schemes of mutual funds as per SEBI. There's been a large shift of capital from the small cap segment to the mid cap and the large cap segment. That's why you see small caps having underperformed significantly. So I would recommend 2 different funds, L&T Mid Cap and Canara Robeco Emerging Equities. These 2 replacing HDFC and SBI small cap would be a good change. Then coming to your question of what kind of are your goals meetable with the current disposable income and saving, I would say both her objectives with respect to her child are doable with the current investing pattern. But for her to plan for her retirement, which is her duty, because there's no retirement loan, you might just get a loan for the other 2, but not for your retirement. So you'll have to increase your savings from a every year perspective as your disposable income goes up by 10%. If you so did it, then your retirement 5 crore objective could also be met.
Okay. In fact, the question also that she asked is, again, that as she increases the SIP, should she do it in the same funds? I mean, of course, replacing the Parag Parekh, like you mentioned, because it's better to stick to the top 7, 8. After those rejigs, should she keep topping up her SIPs in these same funds, or should she consider then rejigging? Or these are fine then?
I think 6 funds at a point in time is good enough.
Okay.
So nothing to say that this should be the same 6 funds. You should get your portfolio reviewed because you're a caller who's a very regular viewer. I think if you write back after a year to understand whether the schemes still remain contemporary, that will be a better strategy. So limit your schemes to number of schemes to be 6. But make sure that you're doing a review periodically and writing back to us to see if those schemes still have relevance in your portfolio and their fitment in there to help you meet your goals, Anita.
All right, she has one more question actually. She says, though my portfolio is in the green, there has been a significant correction in it. So she wants to know, are mutual funds still a better way to create wealth? I think a valid question. And like you mentioned, external factors, market-related factors, which may have caused a dip in the NAV. So just for the benefit of Anita, if you would like to, completely eliminate any sort of doubts in her mind about MFs.
See, I think I generally have a tendency to look back at data to answer questions. So if you, this is not just an Anita's concern. People have a large anxiety when you speak to people who are participants.
Yeah.
That is the game over? Will I be able to use this as a platform at all? If you see the last 10 years, there have been instances during bull runs, there have been 6, 7 such corrections. And the time taken to recover from a correction like that averages 7 months only. So when people sail through these 7 months of tiring times, what comes out is significantly good. So I personally think these ups and downs is what helps your SIPs get a better cost or a better price when the markets go down. So you're anyway staggering your money. Please don't be bothered about this short-term volatility. You will hear a lot of news, a lot of noise. You have to cut the clutter and stay to the course. And I'm sure expecting a return of 13 to 14% from equity funds over long periods of time is something as fair as it could get from an investor standpoint.
She's already on the right path. I mean, she's nicely set aside some money. She started her SIPs. So I think it's great. She has 12 years to go before her very first objective has to be fulfilled. So I think kudos, Anita. And of course, thank you for being that regular viewer on The Money Show. All right, let's take the next question. Anirudh has sent in a query. He says, I'm 29 years old and have been able to put aside 70 lakh rupees as savings. Well, lucky Anirudh, because I'm still a far cry away from that goal. He says, could you please guide me now as to how I could possibly manage this money in a better manner? My goals for the future are essentially child's marriage. That's 18 years later. He wants to spend a nice 3 crores for that. And for his own retirement, he wants to spend 4 crores. Again, I think I'm very disturbed by these figures over there, because he literally wants to spend just about 75% of his retirement money on his child's marriage. I hope I'm invited for this marriage, by the way. But anyway, let's get to answering Anirudh's question. 70 lakh rupees saved. And again, it's a long term, at least about 20 odd years roughly. So mutual funds is the way. And also, most importantly, assuming he has no other investments, is it wise to essentially put all your money in mutual funds, or should there be adequate diversification over there as well? I'm talking about, bank deposits or other sort of government schemes available.
Also, I think what comes to my mind when I see this is, I don't think Anirudh has factored in the inflation concept reasonably well. 25 years later, with 4 crores, it's definitely not going to be sufficient for you to live a life of 20-25 years subsequently, because we are seeing some obituary data and some mortality data of India of 1 crore people who actually are no more. The average lifespan of an Indian male is going to be 82, 83 years. Yeah. So you will have to live off the same corpus for a very long period of time. And 4 crores at that point in time will hardly have any value, especially
almost 30 years, in fact, after
30 years from now. Yeah. So I personally think that you will have to relook at this. Inflation numbers have to be generously factored in. So I think a 15-20 crore number might look not so reasonable today, but that will be the norm at that point in time. So relook at it. Set your goals perfectly fine. 3 crores for child's marriage. I think from inflation perspective, Mubina's point well taken. It will not be a large amount at that point in time, hopefully, Mubina. But the retirement definitely requires
That's
far
really
more.
Scaring me as well, by the way. I mean, if I have to shell off like 3 crores for my child's marriage.
We saw some data 40 years back, what you needed to buy with 100 rupees. Today you need 5,000 rupees.
Wow,
okay. So it's depleted in 40 years to the extent of 50 times.
Yeah.
So you will need far more money than what you think and what your mind can comprehend. Coming back to his question of what should he do with his 70 lakhs, assuming he has no other investment, which is unlikely, because if you're a salaried employee, you would be saving in the form of some EPF, PPF and stuff. Let's assume this is risk capital, or at least long-term capital. Risk capital is a negative connotation. So long-term capital of 18 years, I would say he can go into equity because he's sub 30 years of age. But let me add some more funds. About 7-8 funds are better than 4, which I thought would be sufficient. So I can read them out for him. So Reliance large cap, Mirai Asset large cap, Kotak emerging, Kotak standard multi cap, Canara Robeco emerging equities, L&T mid cap, SBI focused equity. These 7 funds, I think, if you distributed your money, it'll give you 230 stocks in your portfolio. The standard deviation of this combination, like we've been on the topic, so it'll be about 12.5 of the combination, not just individual, which is what you should be concerned of. So these are the funds which you should buy and spread your money and stay the course, especially if you're investing now. I think a lot of pain is behind us.
Okay, so Anirudh, the 3 funds that you can see on your screens, that plus Feroz has added actually 4 more. I hope you've taken note of that. That's essentially how you should go about your investment journey. You're young, you still have a long time to go. So don't worry, and you've already saved up a nice 70 lakh rupees, so kudos to that. Okay, we've just received an email query. I'm going to read that out now. It's Balakrishna Rao who said that I'm investing in the DSP small cap fund for the last 30 months through SIP mode, but it's performing poorly. Should I continue with my SIPs or quit the fund? Okay, it's only one fund. I can assume that safely, and it's not been performing well. How would you answer him? Again, you know, Feroz, this is the point that we've been making for some time now. But along with the fact that you shouldn't be too concerned about the markets, also explain to him why you have been stressing on the fact that you should have 5, 6 mutual funds and not just one.
Yes, I think, Mubina, again, this reminds us that it's important to start right.
Yeah.
Otherwise, you burn your fingers and go out and then start concluding that this is not meant for me. That's a very scary conclusion to derive and an incorrect one. So have several funds in your portfolio, point 1. Point 2, never start with a small cap fund. That can never be a core portion of your portfolio. It can be the peripheral portion after you've built the core. Core portions are going to be, the first fund has to be a large cap fund, the subsequent one or the multi-cap fund, one of these two. The subsequent one has to be multi-cap and large cap, 2 funds. And then you get into mid-cap. And then when you have two of each of these categories, then you get into a small cap fund. Yeah. Just if you, on the basis of past performance, if you choose, then it is but likely that after a bull run, small cap funds would have given the best return. So you'd be lured to that. But driving, looking at the rear view mirror is not the best idea unless you're going backwards. So please look at the windshield, look forward rather than backwards. That's the point I'm trying to make for Mr. Balakrishna.
Okay, so yes, unfortunately, Mr. Rao has started the other way around. He started with a small cap fund, but start with a large cap or you know, an index fund as well could serve the purpose, or a multi-cap fund, move to mid caps and then small caps. That's essentially the order that you should follow. Well, that's it. I think an A to Z of what you need to watch out for if you're kickstarting your investment journey now. It's never too late. And I think Feroz will always be here. The Money Show will always be here, of course, to guide you. So send in any questions or queries you have. Feroz, we're out of time, so thank you so much for joining. It's always a pleasure having you with us. Folks, kickstart your investment journey now. It's never too late. And also, we on the Money Show believe that investing your money and earning money is not enough. You also need to save your money to get rich. And hence, we've decided to start and launch the TMS Savings Challenge. Every penny saved is a penny earned. However you save money, be it by simply brewing your coffee at home instead of walking over to a cafe and buying an expensive one, or simply making your own lunch instead of going over to a restaurant and ordering something expensive. All of this will lead to long-term savings. Share with us how you save money, how much you saved, and we will be featuring some of the most innovative money-saving ideas right here on The Money Show and also all across ET Now's social media handles. Okay, so start saving, start tweeting. For now, we'll take a very quick break. Come right back as we will be talking about the massive surge in gold prices. Welcome back. You're watching The Money Show right here on ET. Now, we told you the ideal ingredients and the recipe to create a portfolio that will help you match and meet all your long-term wealth creation objectives. Now, it's time to talk about a big money maker. It's something that all Indians have, well, almost all Indians have, and do possess either in form of, heirloom or in any other form, gold. And luckily, because of the fact that we Indians have such deeply rooted love for gold, almost all of us, let me correct that, have been able to enjoy this massive rally witnessed in gold prices. Indian gold prices are at a record high. We are nearing 38,000 rupees. In fact, in some bazaars, you'll actually get that 38,000 rupee figure for 1 kg of gold. Of course, what's aided these gold prices has been the fact that globally gold prices have gone up. But additionally, remember, in the budget, FM Sitaraman had also caused the custom duty to be hiked from 10% to 12.5%. This is something that has really added to the glitter of gold, and I'm sure all our households out there, especially all the women who do have all the gold on them, are extremely happy reading this news. Now, the question is, what should you do then to be able to really realize these gains? What should you do with all the gold that's lying in your locker, or for that matter, even in your demat statement? How can you benefit from the rise in gold prices? Also, another very important instrument is taking a loan by depositing gold. There are lots of gold financing companies in the market. Does that impact that in any manner now that gold prices have gone up? We decided to get all these questions and queries answered with Pankaj Matpal. He's the MD of Optima Money Managers. Mr. Matpal, thank you for joining us on the Money Show. Like I said, you know, gold, a very, very popular asset, is something that has finally managed to make a lot of money for all our households out there, all the women out there. But mind you, after being dead for so many years, gold really did not make money for a very long time. And it's only now that we are seeing a massive rise come by. So, Mr. Matpal, let's start off with this. How can then our viewers make money out of this massive rise in gold? Because at the end of the day, that's all we want to know.
Sure. See, buy low and sell high. That is the objective of investment. If you want to make money, you must sell when the prices are high. So at this moment, when you are saying you are seeing that rise in the gold prices, is the best time to sell it. But as you said, that every individual in India has gold in their house, but does not mean that they want to sell it. Most of the time it is for consumption, not for investment. But if you feel that it is kept for a long time, you're not using it, you want to make money. So my suggestion that you must think of selling it, because it is at all-time high in India, trading at around 38,000 per 10 gram, which is the record high price. You must take benefit out of this, and you must sell gold. Second thing, because most of people are asking that whether they should invest now, because we have seen in any asset class, when you see the prices are very high, people become more greedy and want to invest more and more. But here I will say that this is not the right time to invest in gold, because we have seen that gold is considered as a safe haven. Whenever there is geopolitical tension, where there are uncertainties, people invest more in gold internationally, in India as well as in the global market. But this is not the actual demand, I will say. If you see in international market, the gold is trading at say 1,500 USD per ounce. And if you see in 2013, it was trading at $1,700 per ounce. It means in international market still gold is trading at lower price than it was earlier in 2013. But in India, if you see right now, the gold price has touched 38,000 per 10 gram, and whereas in 2013 it was 28,000 per 10 gram. It means it is not the gold demand which has gone up, it is also the dollar price, dollar versus INR. So today, because dollar is around 71 rupee, and in 2013 it was 61. So gold demand is one thing which increases the gold prices, but more than that, another important point is that dollar versus rupees. So what I mean to say, if tomorrow economy improves in India and rupee appreciates, automatically the gold prices will come down. So that is why, considering this, that this is not the gold demand which has helped, only the gold demand which has helped increasing the gold prices, it is the dollar versus rupee. Because dollar is costly right now, that is why, because we import gold in India, we don't mine it now, and that is why the gold prices are higher. And second thing, as you also mentioned, that import duty, which is 12.5% right now. If tomorrow import duty comes down, gold prices in India will also come down. So that is why my suggestion that considering that gold prices are all-time high and people are more and more investing, my suggestion is a time to book profit instead of investing in gold.
Very good point, actually, Mr. Matpal, that you have raised. Do remember, folks, just to reiterate, he essentially has said that demand is not increasing in India. The only thing that's changing is that the rupee versus the dollar has depreciated. So in the global markets, gold had actually touched 1700, almost 1700 in 2013. We are still at 1500. So in the global markets, gold has not gone to its record highs. But in the Indian markets, because of the rupee, weak rupee is contributing to the rally. That's the reason why gold has gone to record highs in India, but not in the global markets. If tomorrow FM Sitaraman says that, hey, listen, I'm going to cut the custom duty on gold, be mindful that gold prices in India will fall. Right now, it's at 12.5%. Tomorrow, if she cuts it back to 10%, it will fall. If she cuts it even lower, it's going to fall even more, because we in India are gold importers, not gold miners. It's a very important point. So be wary before you decide to buy gold at such an important juncture. But for all those out there who have some, gold bricks perhaps, or gold ETFs lying around, since it's at a record, it's the best time to sell, because the idea is buy when it's low and sell when it's high, and not vice versa. Mr. Matpal, now that is of course the most ordinary gold jewelry that's lying at home, and like you mentioned, that's usually for consumption. But a lot of people out there have gold ETFs as well, or e-gold. Does that as well adequately represent gold in its pure form that's in the market? And if so, would it be the right time to sell those too?
Definitely, gold ETF is basically exchange traded fund, and underlying asset is physical gold only. The issuer, they buy physical gold on your behalf. It's like any mutual fund scheme, any ETF. The underlying asset is based on the objective, whether equity shares or bonds, or in case of gold ETF, it is a physical gold. So it is the right time to sell if you are holding units. And I'll say that for long you have been waiting for this day. Because gold was not performing well for quite some time, and now the time has come. So you must redeem your units of gold ETF. So if you are thinking of booking profit, it is the best time.
Okay, now, like I said, it's the best time to essentially consider moving out of gold, because it's at a record high, especially if you have an ETF. Mr. Matpal, another very important factor is taking a loan by depositing gold. Lots of companies out there are what you call as gold financing companies. Basically, the gold that you have in your home becomes a collateral with a financial institution, and against that, they give you money. So ideally, Mr. Matpal, depending on the value of the asset that you are depositing with the financial institution, you get an X amount of money. Now that obviously the value of the bullion that I have at home in the form of jewelry or bricks or any other form will obviously have increased because of the rise in gold prices, does it, impact me as a borrower in any manner or in any positive manner?
See, loan you will only take when you need money. If you need money, so it's a secured loan which is comparatively cheaper compared to your personal loan. So that is only used as a collateral, your physical gold, and you can take loan. But that does not mean because gold is trading at a high price, so you should essentially go for loan. It is only the need. If you need loan, so instead of going for a personal loan, you can go for the loan against gold. And usually these lenders, they offer you 75% of the value of the gold, and rate of interest is around 10%. So that can be one choice when you need money, that you can borrow money against your physical gold. But if we can talk more about this like investment, one more option is gold, sovereign gold bond. That should also be considered because Government of India has launched it, and right now it is available, which is going to close tomorrow, and again in the month of September it will be launched again. So sovereign gold bond is one good choice because you buy gold at the prevailing rate and you can sell it, you can redeem it in future at the time of maturity or after 5 years of holding at the prevailing rate. So along with gold ETF or gold mutual funds, See, people who do not have Demat account, they also have choice to invest in gold in the form of gold mutual funds. Gold mutual funds ultimately invest in gold ETF, and gold ETF invests in physical gold. And as I said, another choice is gold, sovereign gold bond, which are launched by Government of India, available in post office and banks. So you can invest in that as well. The best part is that apart from the appreciation in gold price, government is also offering 2.5% interest every year paid half yearly. So that is the additional advantage as compared to the gold price. Whatever the benefit you will get, you will also get interest. And second thing, if you hold it till maturity for 8 years, then there is no long-term capital gain on sovereign gold bond, capital gain arising out of this sovereign gold bond. Otherwise, when you sell your physical gold or your gold ETF, it is subject to long-term or short-term capital gain. So that is for investment. If anybody wants to invest, that is a better choice. And loan, as you said, I explained already. If you need money, then only think about taking loan against gold.
So that loan bit won't impact actually, even if the value of your gold has gone high. But yeah, I think Mr. Matpal gave a very interesting instrument as well, that sovereign gold bonds. Fact that it's sovereign means it's virtually risk-free. You get a neat 2.5%, small relatively, but you get the gold appreciation as well that gets added to your overall wealth. Mr. Matpal, really appreciate you joining us. Thank you so much for giving us this lowdown on what's causing gold to glitter and how, folks. I'm sure you guys have made a lot of money. And according to Mr. Matpal, if there's any spare gold that you have, do use this opportunity to sell it and enjoy the profits that you will have earned, because Indian gold prices are at a record. We don't know what's going to happen tomorrow because it's subject to market forces. On that note, we'll take a very quick break right here on the show, but when we come back, we are going to be meeting the fund manager of the DSP Equity Fund. So all the unit holders out there, do continue tuning in. We're going to get in Atul Bhole's strategy. Back, you're watching the Money Show right here on ET Now. We spoke about mutual funds. We also spoke about how you should make the most of the rally in gold. And now, for all the current investors and the prospective investors of the DSP Equity Fund, listen up, as I've decided to meet the fund manager of the DSP Equity Fund, Atul Bhole. Before that, a quick introduction of what exactly the DSP Equity Fund is all about. As the name suggests, it's from, of course, the stable of DSP, and it is a pure play equity fund. This is what the returns look like. Just like many funds in the market, this one too has shown a negative return of roughly around 4.5% in the last 1 year. However, if you hold it for the long term, you will see some results. 7.5% on an annualized basis if you held it for 3 years, and then 9.42% if you've held it for 5 years. As is the case with equity markets, patience is a virtue. And same is the case with the DSP Equity Fund as well. Longer term, this fund has done well. Let's take a look at the sectoral spread. And there's a nice 41% that has actually had exposure of 41% of the fund that has exposure to financial services. Basic materials comprises 10.5%. Consumers is 9.6%. And then other stocks like auto ancillary infrastructure, that's roughly 38.3%. That's basically the balance of the fund that has exposure to other sectors. Here are the top holdings. Since more than 40% of the fund has an exposure to financial services, some of the top holdings as well are from the banking and financial space. So a neat 7%, in fact more than 7%, is comprised of some of the biggest names in the financial industry. HDFC Bank, one of the largest private sector banks, ICICI Bank and Bajaj Finance. Then we also do have, again from the banking space, Axis Bank, wherein the fund holds approximately 6% of 5% in Axis Bank. 3.9% of the total assets are in Kotak Bank. And then finally, talking about other consumption names, it also has a neat 3.7% in Hindustan Unilever or HUL. This is, of course, from the consumption space, but the first 5 stocks are all from banking and finance. Next, there's TCS. 3.59%. This stock has been very resilient. Again, Asian Paints, a B2C facing company, 3.25%. And another IT company, Infosys, which has managed to find approximately a 3.2% stake in the fund. So that's, of course, the major composition of the fund. All right, let's now bring on board Mr. Atul Bhole and talk to him about his investment strategy when it comes to the DSP Equity Fund. Atul, thank you for joining us on ET Now. To start the conversation, first, tell us about the basic theme of the DSP Equity Fund.
DSP Equity Fund is basically the flagship fund of DSP Mutual Fund, and it's a multi-cap scheme. I can buy a mix of large cap, mid cap, as well as some amount of small cap stocks into this fund. By and large, this fund is sector agnostic and market cap agnostic. So basically, and the philosophy or the style I have adopted is basically to buy companies which are very good on business and management and delivering consistent growth. So basically, these kind of companies can be slightly expensive at some point of time, but we have seen that in last 10-15 years, the companies which are delivering good and where the accidents are not happening frequently, such companies have delivered consistent returns to the shareholders, rather than trying to look for value stocks and hoping to realize significant gains from such value stocks. So the focus is on delivering consistent returns through investing into quality companies which are delivering compounding growth.
Well, yeah, the top 10 stocks are, of course, from the bluest of the blue chip names. Okay, Atul, let's also talk about the beta. We were talking earlier with Feroz about standard deviation. That essentially represents risk. Beta as well is a factor that represents how much risk a fund has. Now, in DSP Equity Fund's case, Atul, the risk is over 1. So would you say that perhaps the fund would not be for those investors who may be a little too conservative? Would you say that the fund is a little on the riskier side?
Yeah, I think currently the beta would be slightly higher, because lot of investments, the overweight positions are into financials, and some of the financial by nature have slightly higher beta than the entire market. So to that extent, the fund is a bit volatile than the market. The other thing why the beta of the fund is higher is basically I have avoided certain large companies or the companies which are having very overweight position into the index, because they are not fitting on my fundamental criteria of good business and good management, etc. Basically, I try to avoid companies which try to do various businesses through a single company. And because of that philosophy, I have not invested into those large weight stocks into the fund, and because of that reason, the beta of the fund is slightly higher. But I would say this kind of volatility will gets even out over a longer period of say 3-5 years, and the fund ultimately would deliver returns in line with the earning growth of those companies. And we are confident that the companies which have chosen, they can deliver 15-20% kind of compounded growth over a period of 3-5 years. So accordingly, investors can take decisions to invest in this fund. But I would say the better approach would be to allocate accordingly, rather than say selecting or taking the decision of avoiding or selecting the fund altogether.
Atul, a very pertinent question is that in a world where we are looking at, DHFLs and ILNFS, what's your strategy to weed out the bad from the good?
So basically, for picking out good and the bad from lot of listed companies, basically what we can do is rely on the track record of the company, how the company has delivered in tough times, good times and tough times in last say 5-10, or the history of the company. Whether they in a good times how much expansions or grid they have gone into, and in tough times how they have saved the company or navigated the company in last 5-10 years. And at the same time, we can look at the management, and we keep on interacting with the managements as well as the channel partners like dealers, distributors and vendors of the companies, through that we develop certain ideas about the management, what is the DNA of the management and the approach, their approach in conducting the business of the company. So through these various channel checks as well as connecting with the management again and again, and looking back into the history gives us fair idea about how this how we can separate out the good boys from the bad. But having said that, out of 10 there can be 1 or 2 mistakes which can happen, which we cannot avoid the mistakes altogether. So the approach for managing this kind of risk is to diversify, and as you can see the funds have around 45 to 50 holdings, and through that we are taking or reducing this risk of getting 1 or 2 bad companies also in the funds.
Well, yeah, they are inherently risky in nature. And finally, Atul, leave a message for our current as well as prospective holders of the DSP Equity Fund.
If you see last 20 years return, the fund has delivered somewhere around 18 to 20% CAGR returns for last 20 years. Obviously, that is a history, and I can't guarantee the history will repeat itself as per regulations. But really, if somebody is looking for generating long-term good returns of over next 5, 7, 10 years, one can look at the kind of companies which we have chosen for the fund. Most of these companies are very well managed and probably will deliver around 10, 15, 20% kind of earning growth, and somewhere around that kind of return or slightly lesser than those returns which we can expect from the fund. I am saying slightly lesser because I accept that the valuations are slightly higher on this kind of companies, and there can be a case of derating as the economy prospers and the interest rates into the economy comes down.
Okay, Atul, thank you then for joining in and of course sharing your investment strategy with all the unit holders and the prospective unit holders of DSP Equity Fund. Well, that's all we have for you on this edition of The Money Show, but we are going to be back tomorrow with a brand new episode. It's that time of the year when your kids may decide that they want to go abroad to study. Are you financially prepared for it? Know how to create a portfolio that will save money for your child's education, and also know the true cost of how much an education abroad will cost you, and when and how should you opt for educational loans. If you have any questions or queries on this, we will be joined by Anshuman Mishra of Loan Adda, who is an education counselor for all abroad education needs, and he also deals with education loans. Send in your questions and queries, and tomorrow on The Money Show, we will be taking them up at 5 p.m. Okay, on that note, thank you so much for tuning in to The Money Show. We will see you tomorrow, same time, same place.